You're making this point 2 weeks back that the broader market will catch up. It has, and how? And this rally feels a lot different compared to the last rally when everyone was feeling miserable. Your thoughts on whether this is start of something big?
Yes, so Anuj, if we step back and evaluate the fundamentals, I think India's fundamentals have made a trough sometime last year. And I think we are at the beginning of a new fundamental cycle. Now, these are long duration cycles. They tend to last for 5-7 years. So arguably, I would say that, we are at the beginning or, maybe a few months into a 5-7 year cycle in which I think we should witness pretty strong earnings growth. Mind you, corporate revenue growth has already put a trough almost 2 years ago and has been accelerating. Profits haven't for various reasons, which we'll not go through right now. But a lot of those reasons I think are now we're done and dusted with those. So it will not surprise me if earnings put in a 20% CAGR over the next 5 years. And then you step back and evaluate what the market is priced in. The market is not oblivious to a new earnings cycle, but certainly it cannot price in a long duration earnings cycle. What it can do is look forward, say 6-9 months, and put that into the price. So a little bit is in the price, but there's a lot more to come. And therefore, I think it's a good time to be engaged in equities. Now, there are some near-term issues, of course, with the market. The market will want to price in an election outcome. I would say that until a month ago, the market was agnostic. It was not willing to actually make a call. More recently, I think the market has started making a call that India will vote in a majority government. And if that conviction in the market grows, then I think we'll be in for a pretty powerful move in the market, or a continuing powerful move until the elections. And then the setup will look very similar to 2004. And if the electorate does not surprise negatively, then I think we should see a continuation of that rally into the second half. But of course, if 2004 happens, then there could be volatility around it. So I think that's how I would picture this. The fundamental cycle is at the start of a new uptrend, which could last for a few years. Valuations are somewhere in the middle of the zone, so there is upside there. And of course, there are near-term issues around elections.
This comparison with 2004, I don't want to compare from the election angle. In other ways, Indian growth also started picking up around 2003, and we saw that long cycle of growth. We also had a very good liquidity inflow around that time, globally as well as in India. But what does not seem to be similar to 2003 uptick in the growth cycle and now is that the global growth is not ticking along with us. There is a slowdown in global economies. Will that hurt your theory in any way?
Yeah, Lata, actually there are quite a few dissimilarities with 2004, not only where we are in the global cycle, which I think is a pertinent point, i.e. global growth doesn't look like putting in a 5% number annually for, say, the next 3 or 4 years. It's more likely going to be 3.5%. So clearly we don't have that tailwind from global factors. But we also don't have the same tailwind from valuations. Mind you, at the bottom of the 2003 cycle, the Sensex was trading at 2 times book. Today, it's around 3.2 times book. So it's measurably higher in terms of valuations. It doesn't have the same valuation picture. In fact, I would say 2003, both fundamentals and valuations were at bottom of the cycle. In 2019, fundamentals look like they're at the bottom, but valuations are not. Now, on your point on global growth, of course, that's going to be a headwind for India. And I therefore don't think that we will deliver the type of Nifty earnings growth that we saw in that cycle. Between 2004 and 2008, Nifty earnings compounded at 30-35% per annum. And I think that's quite unlikely. I think the number is more likely to be 20%. And the reason that difference is the reason between the two periods, the difference between the two periods is this global factor, which will continue to be a bit of an overhang. So, yeah, I'm with you on that.
Just to scratch that 20% growth estimate over the next 5 years a little further, just trying to play devil's advocate here, we speak to a cross-section of industries, and whether you talk to the auto guys or the power guys or even CMIE, all of them indicate that there's a slowdown underway and it may take at least 6 to 12 months before investments actually pick up. How does that tie in with your 20% earnings estimates?
So Sonia, at the outset, you must push back on this because, you know, I said the same thing 2 years ago and we didn't get 20%. So let's have that thing on the table. And the reason I've gone so horribly wrong on the earnings cycle is because a lot of things happened in the last 2 years which we didn't anticipate. You know, to start with, demon happened. Now, demon happened, and then after that, I think the impact of demon lingered on much longer than I had thought. I think most of us thought that it'll be done and dusted in 6 months, but it kind of stuck around because, you know, in the meanwhile, GST got implemented. So a few things happened which went against us. I think the NPL cycle in the banking sector also lasted a tad longer. And we've seen a little longer time frame for the government to respond with infrastructure capex. Now, if I look now, I think a lot of those things are behind us. So the banking sector NPL cycle, I think, is done. We've had a pretty strong stimulus from the government in terms of spending, and therefore government capex. And we have to aggregate both SOE as well as state government and central government capex, not just central government capex. You know, together these numbers look like they're at all-time highs relative to GDP. So they're compensating for the lack of private capital spending. Also, what has happened notably, which I don't think we should ignore, is that 2 years on, more capacity has got utilized in the private sector. So right now I would estimate, or I should say guesstimate, that utilization rates are in the low 80s. And another 2 years they'll be in the low 90s. Now it's a time at which capacity needs to come on stream. So sometime in the second half this year, post-elections, I think the private sector will start debating capex. And in 2020, I think we should get some capex from the private sector as well. Now, capex or investments are very important for corporate margins. What we have not seen in the last 2 years is corporate margins. It's not lack of revenue growth. The revenue growth made a bottom a few quarters ago and is now well into double digits and has been rising sequentially quarter on quarter. What we have not seen is margins, and margins are, you know, on a macro basis heavily linked to the investment cycle. So the fact that the investment cycle, in my view, is making a comeback should augur well for margins. Now, the point you make, Sonia, on bottom-up analysis, you know, just be careful about taking corporate feedback, because companies don't know in advance that the earnings cycle is coming. They also go wrong on their guidance very often, in fact, if not. Therefore, you have to be careful about just relying on them as your cue to understanding whether earnings are coming back or not. And I think the best way to do is just to step back and look at where we are in the cycle, like Howard Marks has done in his latest book last year. And when you evaluate the cycle, all I can say with some degree of confidence is that it's more likely to go up than down from where we are. And of course, then only the future will tell us what happens.
Okay. Ridham, 2 months back, this is a market which was clearly oversold, at least on the broader market side. Now, with all this dollar carry trades and, you know, ahead of elections and all that you're saying, is there a risk of this market seeing a bit of a melt up, Nifty making a move, sharp move towards say 11,500 to 12,000, which perhaps may not be too healthy? I mean, is there a risk of that happening? And bulls would enjoy it, but you know.
Yeah, Anuj, you're asking. Yeah, you're asking me to make a 2-month call on the market. I struggle to make even a 2-year call. But anyway, let's try this. No, let's try this. So you're right, actually, in a way. I mean, if I just evaluate, a lot of things went wrong for India between, say, September and February. And actually, it should surprise most people that the Nifty was very resilient through this phase. It hardly reacted to what I would say was a pretty challenging macro environment, whether it was the non-banking sector problem, the IL&FS problem, the RBI government problem, the fact that we had, you know, liquidity problem in the system overall. A lot of things went wrong. Oil prices shot up and then, of course, went down. But a lot of things went wrong, and the Nifty should have behaved more poorly than it did. It hasn't actually behaved that poorly. In fact, if you look at it from the beginning of October to now, the Nifty is actually also flat against emerging markets. So it's not that India has underperformed emerging markets. It's outperformed, then underperformed. So, and then, you know, has started to outperform again. So it did a little bit of a yo-yo, but it's remained in that range, which in itself is, I think, a bit of a positive surprise. It tells you that there was a, and I'm using technical terminology, there was a underlying bid waiting to happen. It was waiting for all the bad news to clear up. And indeed, they have cleared up. We got good news from the Fed, so they are not hiking anytime soon. So I think global liquidity looks a lot stronger than it was, say, 2 months ago. I think it should reflect in the way foreigners participate in India. And remember, foreign portfolio flows have been very weak in India, and as a consequence, foreign holding in India is down to 7 or 8 year lows if you look at it from a overall portfolio perspective against the benchmark. So their positioning is quite low. It's now turning. It's just coming off lows. There's room for that to go up. I think domestic flows have been pretty resilient. Yes, of course, we've had 2 or 3 months of outflows in non-SIP funds, but overall, I think I'd take this number of 5,000 crores. And I think there's upside to that because the dust on the market seems to have settled. So to my mind, yeah, we are set up. And if the market starts believing that the electorate is going to deliver a strong outcome, then, then your thesis may pan out over the next 2 months. But and of course, the market is also breaking out of the range. So technically, it looks pretty good. So yeah, I mean, it could happen.
Ridham, how do you play this? I know you will not talk stocks, but what caught my attention were 2 or 3 real estate stocks. There was an overrepresentation of real estate in the list of stocks that came in the Morgan Stanley report. And this is coinciding with CLSA also putting up a slightly bullish report on real estate. You think those assets have troughed out and we should look for good stocks in that sector?
Yes, Lata, just to add to what you told Anuj just now, I agree with you. In fact, my view in January when the elections were looking a little bit fuzzy, the election outcomes, our view was that beyond May, the market will start trading the growth cycle. So May will come and go, and the ballot will fade in importance very quickly. So yeah, I would hold on to that opinion as well. On sectors, I think if I were to characterize this in one line, I think you want to buy domestic cyclicals, both consumer cyclicals and industrial cyclicals. I think both of them look quite interesting. I think income growth is looking strong, and therefore consumption in the discretionary space should improve, which includes the likes of autos, airlines, it includes hotels, it includes a slew of sectors which are discretionary in nature. And then industrial cyclicals, which includes the host of industrials, engineering companies, construction companies, the big turnkey guys, everyone. So I think these are the 2 places that I would put money to. And then of course financials, where we would buy select non-banking financials. They have rallied, a lot of them have come back 20-25% from their lows in the last month, but they are still well off the tops. And I think a lot of the problems there have settled down. Growth in those companies may look a little bit tepid over the next year or so as they build more liquidity and capital on their balance sheets, but I think it's more or less in the price. And then of course corporate banks. We're going to get very strong earnings from corporate banks. So they are, you've got to have a bid on them all the way through. They will likely get re-rated and will report strong earnings over the next 2-3 years. So that's the space we want to be. On your question on real estate, I am very bullish on real estate, both commercial and resi. Commercial, the cycle probably troughed 2 years ago and is already on its way up. Resi, I think, will likely trough in the next 1 year or so. So I think you want to buy good quality real estate companies with decent balance sheets. And I think those stocks will do quite well over the next few quarters.
Okay, well, you are not alone in that view. CLSA also has a similar view. We were speaking with Mahesh Nandurkar, and he did mention that, the real estate theme is something that's going to play out. But there's another common thread that runs across all the stocks that you're overweight on, Ridham. That's the rural theme, whether it's, M&M, Maruti, Titan, Dabur, etc., Shriram Transport. Now, do you have any anecdotal evidence or research that suggests that in election years, when there is a farm income transfer or when there is a farm loan waivers, is there any incremental bump up in consumption? Because we were having this discussion, I think, with Technopack advisors a few days ago, where they suggested that there is no improvement in purchasing power, when these income schemes are doled out. What does your study suggest?
Sonia, I don't think we have got such a big rural bent in our focus list, but just to step back a moment and just challenge this concept of rural India. I think, we are relying on very outdated numbers to characterize India's rate of urbanization. I think most papers put that number between 35 and 40%. I think the number is a lot higher, which is India is far more urban than it used to be. And these numbers are almost 10 years old now. And in the last 10 years, India has made, pretty big advances in urbanization. So my guess, my gut feel is that this number is in the 60s now, which is rural India is a lot smaller than it used to be. And again, that portion of rural India is largely dominated now by farmers. So non-farmer rural India is a very small cohort compared to say 10 or 15 years ago. So we should be careful when we characterize rural India as a very big part of India's economy. Yes, the farmers are, at least in numbers, even though not in output. I mean, remember the farmers in all are about 250 million, so they're half the workforce and they contribute just 15% of output. So they are not as productive as the rest of the nation, and they have had very poor terms of trade because of falling food prices. That has been a big transfer of terms of trade to urban India. So urban India is actually looking much better than it was, say, 7-8 years ago when it was dealing with high food price inflation and high generalized inflation. Today, urban India has actually got this big transfer of terms of trade, unfortunately from very poor farmers. So therefore, it is only fair to transfer some of that money back to farmers, which is what I think the government has done. There could be a lot of debate on this with respect to its fiscal impact, inflation impact, but I think just in the context of fairness, I think it is the right thing to do. And these farmers, I think, with the cash that they will receive or are already receiving, should see some pickup in their ability to consume. So I think the outlook does look a little better. Mind you, this did not exist in previous election cycles because we didn't attempt cash transfers in previous election cycles, but we only did subsidies. So this is very different in its nature. Cash is very different from subsidizing things. Cash gives the power of spending, discretion to the farmer. And therefore, there should be some pickup in the so-called rural demand. But it's a lot smaller part of the Indian economy than it used to be.
How important is crude as a risk factor for this market? Because while, right now we are enjoying a liquidity factor, that's also pushing up crude prices. We saw last time our market underperformed because of this being a, very big factor.
More generally, I wanted to add, Ridham, what are the risks to your theory itself?
Yeah. No, I think, Anush, thank you for raising it, because I think in the middle of all this, even I lost the point. I was going to make the point on oil. So I think actually that a lot of India's underperformance in the first 6 weeks of this year against emerging markets was because oil rose relative to copper. Now I don't look at oil prices on an absolute basis. The reason is that oil prices rise for two reasons. One is because global demand is strong. Second is because there is supply disruption in the oil market. How do you isolate that? You isolate that by taking another commodity which will also respond to similar factors. And when oil is outperforming copper, it means it's going up largely because of supply factors rather than demand factors. When the demand factor is there, it will be there for both copper and oil, and then you will not see such outperformance. So the fact is that oil has outperformed copper, and that's not good news for India, because that means that there are some supply constraints in the market. And whenever that happens, India does tend to underperform. I think it remains a risk factor in the short run for the next 2-3 months. If the market gets, say, jittery about the election outcome in the next few weeks, and that's always possible because things keep changing in an election period quite violently. And if oil is going up, then your argument on a melt up could change very quickly. So yeah, I would definitely keep a corner of my eye on oil. Longer term, I think oil will reduce in importance, because its share in India's GDP will keep declining over the next 3 to 5 years. But it's certainly a short-term factor to keep an eye on. And Lata, on your point, I think global growth is clearly something that we should watch out for, especially in the context of US and China trade. I wouldn't underestimate a trade war's ability to disrupt global factors and therefore India's growth rate. And I think we should also keep an eye on inflation impulse in India. I think it's not being considered right now because headline inflation has been so well controlled. But it goes back to my point at the start of this conversation, which is I think utilization rates are rising. And what happens when that happens? Pricing power comes back. So I won't be surprised to see pricing improve across a host of sectors. Now that will of course be accompanied with strong earnings, bullish on earnings, but it also comes with headline inflation. So I think we should keep an eye on that as well.
Okay, all right, Ridham. In fact, thank you for joining us and speaking to us.